And I really appreciate the really nice introduction. And it's strange for me to be titled a guest for today. I've been doing enough of these webinars at Ohio State for a while that that's just kind of a strange title for me to hear. And I certainly do miss being in Ohio. I really enjoyed my time there, and I just got an opportunity to move closer to home and continue my education. So we're going to talk about the economic considerations for ARC and PLC today. For many of you, this seems like we just did it, and you are correct. It wasn't even a full year ago that some of you would have been enrolling for this decision. And for a couple of you, especially in the northwest part of the state, that could add some undue stress to your daily lives after the rough period that we had for enrollment in 2019 with prevent plant and everything else that figured in. So my message is just take a breath. I don't view this decision this year as being overly stressful to your businesses. If you're making this a very stressful decision for your business, I think that there's other things we could concentrate on, like figuring out how to capture some of these grain market prices for next year for the new crop, and thinking about putting a plan in place for that, mitigating some of our downside risk. It's one of those things that when it comes to Farm Bill programs, our best case is that we don't need them at all. And I think we're getting really close to that, where we're going to have to see a major change of events really to see these programs start to kick in. But nonetheless, I just throw this kind of up there as just a reminder that there's reasons that people do get upset with these Farm Bill programs. And I listed the three that I hear most common. For years we heard producers that, especially in the previous Farm Bill, the 2014 Farm Bill, that chose ARC County at the very beginning of the Farm Bill because that was the program that was expected to pay them out the most money. But when we got to the back end of the Farm Bill, PLC was making payments and ARC County wasn't at all. And folks were starting to tell me, well, this is when I need money, right? Like this is now the time where I could use some of these assistance dollars for my operation. So again, it's we get those frustrations that come out. I think a lot of that's been taken care of with this multi-year, enrollment now, if you will, or election change to where we get to amend the election every year. So again, it might be something that you're stressing about, but I think it's something to, just take a deep breath and we'll get through this together today, I promise. I want to give a big shout out to FSA. I think FSA has done a phenomenal job, the last 2 years, getting a lot of these programs up and running. You heard Mary talk about the quality program that is now open as well. That's another program for those crops that, suffered quality issues and were docked at the elevator for, wherever you took a dock. And so they're certainly trying to provide some assistance there. And, that's a new program that they've had to get ready for and launch again this year as well. So their new programs keep rolling. So here's my roadmap for today. We're going to talk a little bit about program characteristics. I know for most of you, you have this known like the back of your hand. You don't need an update. I just find for my benefit, a lot of times it's easier to keep everybody on the same page if we go all the way back to the basics for a second and just cover what each program does. We're going to talk a little bit about price considerations for 2021, a little bit of a market outlook. And then we'll talk about making the decision at the end. So we're going to move through some of this rather quickly, and I hope to get done and we have enough time for questions as we go through. I want to start off, and this is a busy slide, but I'm going to break it down pretty quick. Farm bills operate on program years. So they're not on calendar years and they're not on crop years, they're on program years. And the decision that you're getting ready to make in 2021 is for the 2021 program year. Is for this summer's crop, but the program year won't end until October of 2022, which is what I've got showed on the graph there. As you can see, the full timeline from today all the way to October of 2022. So here we are today, that orange star. The blue star is the decision deadline that you have to make, but then I want you to notice all the data points that are going to come after this that ultimately affect what the ending result's going to look like. So a couple that I think are really important. One, we're not going to know the crop until this summer, until late fall. We're not even going to know the yield, right? This is kind of a little bit of a change. In the past, we've actually been on the backside. We've been a little delayed in Farm Bill enrollment, And so we've had the benefit of knowing the crop in the back of our mind. And this was something I asked Carl Zuloff. I said, Carl, has there ever been a time where we've actually been on time for Farm Bill enrollment? And he thought 1980 might be the last time that we were on time. So I know this is frustrating and you'd like to have more information, but this is how Farm Bill programs are supposed to work. I like to remind folks that this is the idea of how it's supposed to work. The other big thing is we need that price component. We need to know the price of the crop. Well, the marketing year will start this coming September and go all the way through August of next year, of 2022. So we've got a long time. We haven't even started discovering the price yet in terms of how it's going to fit into these program elections. So I just want you to be aware that a lot of things can change between now and then. It might be frustrating, but again, this is where I just tell you to take a breath and try to not make this as stressful as what it has been the last couple of years, because we've known information and we've encouraged you to take the information you've known and apply that to your decision. Well, now we don't have near as much information. So it requires a little bit of a different mindset. Let's start with the PLC program here real quick. So the price loss coverage program, or PLC is what it's called, triggers when the price of a crop falls below a certain benchmark. And that's it. There's no yield component that directly figures into this. And so for here, I've got corn, and the reference price is represented in that black dotted line that you see there. For corn, that reference price is $3.70. For soybeans, it's $8.40. Wheat, it's $5.50. Barley, $4.95, and grain sorghum, $3.95. So it is, there's different benchmarks depending on the crop. And then the marketing year price, which is represented in the red line, is the annual price that farmers across the country get when summarized for basis and futures prices. Okay, so a lot of people get a little concerned about that market year price because it either comes in above or below what they've been getting for the year. But I remind you, it's everybody's basis across the entire country. And those North Dakota states and us out here in Kansas and Missouri, we don't have near as nice of a basis as what you all do in Ohio. And so that's why that market year price is always a little bit lower than what you actually got. But payments are triggered when that red line falls below that black dotted line. And so therefore you can see that for a long time, this program wouldn't have paid out. It paid out in 15, 16, and 17, and 18. But again, it's one of those things that the market year price has to be below that black line. The other thing I've started getting questions about is there is this thing called a reference price escalator, meaning that if prices get high enough, that black dotted line naturally starts to move up. There's a formula. It does exist, but it will not come into effect for the 2021 crop year. Basically, we've had high prices, but we need higher prices or for a longer amount of time for that increase to start creeping up. So these are our reference prices for the year. So just to answer that question up front. In reverse, the ARC County program or the ARC IC, ARC County is county-based yields. ARC Individual is individual yields. It is a revenue-based program, and so it's price times yield, whether that's county yields or individual yields, and those are represented in the black in the red bars there that you see. So this is Greene County, Ohio soybeans, and basically we have a guarantee level. It's a moving guarantee that's based on historical years, and that's represented in that black bar. And so ARC County is really meant to help transition from periods of high income to low income or high revenue to low crop revenue. It's not seen as a detrimental policy like what PLC is, right? Like if prices fall that low, PLC is paying pretty big. Whereas ARC County, it's one of those things that the revenue has to fall in relation to its historical revenue. However, as we'll find out here in a couple of slides, ARC County is far more sensitive to yields. It includes yields. Price can be good, but if you've got a bad yield in your county or a local area, your county could trigger ARC County payments. PLC is based on national prices. So ARC County is a little bit more sensitive to local conditions if you want to think about it in terms of that. And again, payments are triggered when the red bar falls below the black line. And so you can see that for Greene County, Ohio, there was 3 years that triggered ARC County payments for soybeans and 3 years that did not. I want to talk about ARC Individual for just a second. I know for a lot of you folks, especially up in the northwest part of Ohio, ARC IC was a big program, and a lot of people enrolled in it more so than what we expected. It is a completely different type of beast, but it is similar to the ARC County program in that it's based on revenue. It follows that same form I just showed you on the previous slide, only this time it's using individual yields. There's three main differences to ARC individual. One, it combines all crops on your farm. So whereas ARC County and PLC, you can split the crops up. You can do wheat under PLC and you can do corn and soybeans under ARC County or a different combination. When you elect ARC IC, all of your crops, wheat, corn, soybeans, barley, whatever you have, goes under this program and creates that calculated farm revenue, if you will. Second thing is, the revenue is based on your current year's planting rather than historical base acres. You're paid on base acres, but the calculation is actually based on what you planted for the year. So if in 2021, for instance, you plant 100% corn, your entire calculation is going to be on 100% corn, even though you might have planted soybeans the last 4 years or something like that. You didn't have any corn. It's going to be based on what you planted in the current year. So in this case, 2021, whatever you plant will work, which brings me up to the other question that I get asked often. I've been starting to get people to ask me, hey, can I just elect ARC IC? If I've got a farm, it's only 100 acres or 60 acres, whatever it is. I rent it from my neighbor down the road. It's its own individual FSA farm number, and I'm going to plant it to 100% corn because it's just one field. Can I enroll that in ARC individual and get free crop insurance? Yes, the answer to that is you can. You effectively are getting a free guaranteed revenue. The kicker here is that the revenue is benchmarked at 86%, similar to ARC County, but you're only being paid on 65% of your historical base acres. So if you do the math and make the conversion, your crop insurance guarantee or the comparable crop insurance guarantee is 55%. So if you want catastrophic crop insurance, you can do that. But I'm going to guess most of you are going to want to keep your crop insurance as well. Here's the four things that, for me, farms should consider ARC IC if you've got FSA farms. And again, this is based on the number that you have with the FSA agency or, the Farm Service Agency. It's not based on your total, all of the land that you farm. It's just that individual farm number. When we're looking at this, there was this weird trigger that if your farm was 100% prevent plant, it triggered the max payment. That worked last year because we knew what happened in 2019. And so we knew which farms were 100% prevent plant. My guess is that most of you are not planning on being 100% prevent plant in 2021, at least not with these prices. So I don't think number one is really a major factor this go around, or at least a consideration. 2 through 4 are. So if you've got highly variable yields for all your crops within an FSA farm number, I think ARC IC makes sense because basically what you're saying is my yields in my farm, or if you're in a part of a county that's more variable than the rest of the county, ARC individual might make sense for you. This plays really big in some of our counties in the western part of the Corn Belt, to where my family, we're all the way on the east side of the county, and there's a lot of crop production on the west side. If we have a downfall, but in the east side, but the west side does not due to hail or whatever, ARC IC provides us some better protection, risk management. The third thing is high year-to-year production variability. This is where I offer up to you, if you've got some river bottom ground that every couple of years it floods out and you have a loss, or some other factor that creates this high year-to-year production variability, I think that is a case for ARC IC as well for that farm. We've got some river bottom ground. It's all in the same FSA farm number. It went into ARC IC this year as well. And then the fourth point is if you've got large fruit and vegetable acres. I know for some of you that grow tomatoes or other crops in the state, pumpkins maybe, if you've got large acreage of fruits and vegetables on your FSA farm number, ARC IC makes sense due to the calculation of base acres. Now, large is a relative term. You've heard me say this before. I think I'm tall, but then you put me up next to an Ohio State basketball player and I'm short. So here, large is anything that's 15% or more of your acres. So if you've got 100 acres and 20 of them are in pumpkins, ARC IC might be a good alternative for the remaining 80% of your acres that are maybe in corn or something like that. Then the final thing I want to talk about and just kind of give a quick update is this supplemental coverage option. We're going to spend more time today talking about this than I normally do. But basically, supplemental coverage is an additional crop insurance product. It does contain an additional fee. It's through the risk management agency, not the farm service agency. And it's available to you if you have individual coverage for revenue or yield. It's not available to you if you have index insurance or yield insurance. But the only way you can enroll in supplemental coverage option is if you elect price loss coverage. So if you do ARC individual or ARC county, supplemental coverage is not available to you. The attractiveness of SCO is that it fills the gap between your individual policy up to 86%. So if we start with that graph there to the left, the gray bars are your individual policies. And this can be, again, revenue or yield, as long as they're an individual policy. And then the red bars are the remaining percentages up to 86%. And so if you're a low crop insurance user, let's say you just take out 65% crop insurance on an annual basis, you can buy a relatively cheap SCO policy and get area-based coverage up to 86%. So that remaining gap, that, if we're at a 60% insurance policy, effectively we're buying 26% of a county-based or area-based coverage. Now, that's the key word here. SCO is area-based. You still keep your individual policy, but the additional is all area-based, and you don't get prevent plant coverage on area-based products. And so this is kind of the downside of, if you're sitting there going, well, I usually am an 80% crop insurance user, but I'm thinking about dropping it down to 55 or 60 because I can get cheaper insurance with SCO. Your prevent plant coverage goes from 80% down to 60 as well, because the prevent plant proportion is only based on your individual policy. But as you can see to the chart to the right, and this is an example for Union County, Ohio in 2019, which I'll throw this out there. 2021 premiums are going to be higher. I should have taken the word likely out. Premiums are based on current market prices and then volatility. And we've got both. We've got higher prices and higher volatility. So insurance premiums this year, if you haven't talked to your crop insurance advisor, are going to be higher. You're going to have higher premiums across the board. But the true benefit to SCO is it's always been a cheap way to insure more product, to get more coverage, especially for those of you that have used area-based products before. It's a nice alternative to add coverage, add risk management protection to your operation. And we'll talk more about this as we go through. But if you're sitting there and going, is SCO right for my operation? Here's a couple of things I think I would encourage you to consider. If you've got planted acres on your farm that exceed and are more than your historical base acres. So for instance, keep in mind those historical base acres are based on what you've planted in the past. And you don't get to update base and you don't get to change base acres this time, which I know a lot of people would like to update or change their base acres. But, let's say I've got a field and it's 100% corn base. But this year I planted 120 acres or 130 acres of corn on that farm. Because there's, let's say the whole farm's got 200 acres, right? So the base acres are split 100 between corn and 100 in soybeans. But this year I'm going to plant 140 acres of corn. SCO might make sense for your corn acres because it's tied to what you actually planted, where your base acres are tied to your historical base or what you historically planted. So it does provide a little bit more accurate coverage. I also remind you that sometimes crop insurance units don't match up with FSA farm numbers. I know for our operation, we buy crop insurance across our operation, whether it's enterprise or whatever, and it's not broken out by FSA numbers. And so just something to keep in mind there. The second thing about SCO is what I mentioned on the prevent plant protection. You can cheapen your crop insurance bill, especially like, this year where premiums are going to go up and you're like, I'm not sure I want to pay that much for higher coverage. It will cheapen your crop insurance bill, but just know that by doing that, you're lowering your prevent plant protection if we have a year where we need prevent plant again. I'll throw this out there that even at 1% and 6% SCO, so that would be if your underlying policy is 80 or 85%, Even at 1 and 6% SCO, you're adding revenue protection to about the tune of $10 or $60 at current corn prices. So it is, relatively, lucrative given where we're at, price-wise right now. You're adding $10 to $60 worth of protection. You're going to pay a little bit for that, but it's something to consider and think about as you go through. I would also offer that PLC with SCO is the most complete risk management option there is, regardless of crops. It's going to cost you a little bit more because SCO is not a free product. SCO requires a premium, but you're basically getting the best of both worlds. You get the price loss coverage protection from PLC, and you're getting the area-based revenue coverage through SCO, similar to what you get with ARC County. Now, ARC IC is a completely different thing, but I think, if you're sitting there and you're like, you don't know what to do, PLC with SCO is an attractive option. So we asked people last year, if you heard me talk, I asked several of you these questions, but I think it's important to think about how we make this decision this year. What did you all do in 19 and 20 when we were making that 2-year decision? Hands down, the first answer, the number one answer was profit maximization, understanding what market prices were going to do going into the future. The first year always having the biggest influence. And so for when we were enrolling a year ago, 2019 was the first year in that enrollment. And we knew what yields were going to be for 2019. And so it had the biggest influence. It also seemed that producers with higher crop insurance coverages were more likely to do the ARC program than PLC. Again, I think this was just a fact of, if you had higher crop insurance coverage, you were more likely to take, or you were more likely to have higher levels of prevent plant. And so you were encouraged to take prevent plant earlier in 2019, and that encouraged ARC IC. ARC IC was a deterrent for a lot of folks, even though it might have been their most lucrative option because it is heavy risk farm management keeping. You have to keep accurate costs. You have to keep yield data. And so, while it might be the most lucrative, it shunned some people away just because of the sheer amount of work that it took. And so I throw that out there as a possibility as we move forward. And then for producers who indicated that they didn't know which program to choose, they attended one of our meetings and they still left without an idea of what to choose. The majority of them chose the simpler program, which was PLC. It was just the easier to understand program, made the most sense. So right now we're in program year 2020, which was the second year of that enrollment period. And so, we're still, we won't know payments under ARC County or PLC for a while, for at least until October. So we've got a ways to go before we know the full extent of that decision. But at least for 2019, the first year of the decision, what I've done here is I've mapped out Ohio's payments into ARC on the left and PLC on the right. Now, if you're a red county and you're looking there and you're saying, why is my county red and why don't I have a value? That's because your county has both irrigated and non-irrigated yields. And so I'll show you that here in just a second. But if you can look across the state, PLC paid out, broadly across the state for corn. That price was low enough that it triggered below 370. But we had some pockets of the state that had low yields in 2019. And therefore, our county triggered some pretty lucrative payments when it came to ARC County corn. So that's corn. I told you I would consider the ARC and PL or the irrigated, non-irrigated yields. So for those 4 counties that had them, the non-irrigated is on your left, the irrigated is on your right. And so you can see what those payments were there for your respective counties. And then if we looked at soybeans, here was Ohio soybeans, ARC County again on the left, PLC on the right. You'll notice that PLC did not make a single payment across the state. And that's because it is only a price function. And the market year average price never fell below 840. So if you're sitting there and saying, well, if it didn't fall below 840 last year, it's probably not going to fall below 840 this year. And you're looking over there saying, well, look at those those ARC County payments. Again, that's the sensitivity from the yield component of ARC County, if you want to think about it in terms of that. And here's those counties that have both irrigated, non-irrigated yields. Non-irrigated on the left, irrigated on the right. I want to finish up and show you wheat. These are the wheat wheat payments across the state per county. ARC County on the left, PLC on the right. Probably the most interesting thing for me for wheat was that the payments were roughly the same for the 2 programs. They were a little bit higher for PLC, but you're looking at, 40, 45 bucks an acre for PLC in parts of the state. And you're looking at $35 to $40 per acre for ARC County across the state. So again, if you're over here on the eastern side of the state, ARC County paid out more than PLC. But if you're in the west, PLC paid out more than ARC County, but it was relatively close. It was much closer than what many people expected going into it. So Farm Bill election did change. We saw a shift in all commodities towards more PLC in the last election from the 2014 election. This is just really a symbol that market values do drive this decision. You all told me that was your number one factor, and this pretty much just solidifies it, that market data and expectations are a big component of election. You can see here in corn, we went from 7% PLC enrollment in 2014 to 76%, 75% enrollment in PLC in the 2019 election. That's a big shift. If you look up and down, PLC grew in every commodity. Wheat, it went from 42 to 93. Grain sorghum from 66 to 93. PLC became a very attractive program with the lower. Fabulous job. I just try to keep up. A couple of things I'm watching. COVID resurgence. We saw the highest peak we've seen throughout the entire COVID process in terms of deaths last Friday. So COVID deaths reached a peak higher than what we saw even in April and March of last year. That signals to me that we're going to see more stay-at-home orders in place in parts of the country. More limitations in terms of mobility, restaurant slowdown, stuff like that. That has the biggest impact on gasoline use. We're not driving as much and therefore has an impact on ethanol. So I guess my big thing I'm watching, and I've consistently been watching, is I am concerned about ethanol demand. I think we're going to continue to see ethanol demand. We saw USDA lower their ethanol demand forecast yesterday. They actually came very close to where I've been for a couple weeks now. So something to keep in mind. The other thing is Chinese demand. I would encourage you to look at the underlying concepts of what's driving this Chinese demand. China buys what they need, and they've got some fundamental structures that have created a need for grain that I don't expect to be there a year from now. They could, but I'm not expecting them to be there a year from now. There's also a policy in place that basically taxes corn imports into China once they reach a certain level. We've heard rumblings that China might increase that. Of course, when you take the tax off grain, it actually increases the possibility that they're going to import more corn. So that's kind of the trade-off. I see them, having more corn next year. They're going to grow more corn. Ukraine's going to return back to producing corn that they can import. And so, on one side, they that corn demand that we've seen this year might dry up. But on the other hand, if they increase their tariff rate quota, that incentivizes more corn imports from all over the world, including the United States. Right now, all attention is on South America. Dryness in the South American crop is starting to creep in. We're seeing it in the Mato Grosso region of Brazil and other places, Argentina especially. The big story, and you'll hear me say this a little bit later, when we look at Brazil, they keep getting that $1 million rain. Every time they've needed a rain, they've got it, even though their growing season overall has been dry. They've just got the rain when they needed it. A couple other things in there, in terms of technical money flow into the sector, grains are attractive. And so it's attracting some outside speculators, investors into the market. And then when we look ahead to 2021 production, the fight is on. And I'll talk about this here in a little bit, but whichever crop emerges as the victor for U.S. crop acres this year, the other crop is going to have a very bullish price signal. And I think the story here is we currently just don't have enough acres of corn and soybeans to fit the demand, or at least what price signals are signaling to us at the moment. Now, we could overshoot this. I want to be clear. We could overshoot that. But thanks to a short crop, 2 years of short crops here in the United States, a short crop in Ukraine, a short crop in Argentina, we're suddenly looking at some possibilities that prices are very elevated, and rightfully so at the moment. So I want to just touch on USDA's report yesterday, because I know it hit the news and everybody was watching it. That far column to the right, that's actually January, and I should have changed the title. It's not December. This is January's numbers from yesterday in that far column that you see there. A couple of big things. One, they shrunk that yield from 75.8 all the way down to 175.8 all the way down to 172 bushels to the acre. That was a big adjustment. I'll show you how big here in just a second, but it really lowered our supply. And when you look at that total supply number since September of this year, just 5 months ago, we have shrunk 1 billion bushels out of our supply side of the equation, supply side. That is not USDA just being wrong. We had a derecho that hit during that period. We had a drought. There's several things that fit into that. The interesting thing is demand is really softened. It's been something I've talked about for the last couple months. If you listen to my webinars, demand continues to be soft in fall. They lowered exports yesterday 100 million bushels, but that's still 225 million bushels above where we were in September, signifying that increased Chinese demand. But you look at that farm price, that season average marketing price for 2020, 2021, and we're 70 cents above now where we were in September. So the big story here is reduced supply, just 1 billion bushels out of our supply sheet. The concern is on the demand side. We'd really like to see that hang on, but it is showing some softness here in the last couple of weeks. When I look ahead to next year, you can see my numbers for there, but to me, the hardest number to predict right now is that top line, that area planted. Market conditions are favoring soybeans right now, and heavily favoring soybean acreage, but producers love to plant corn. And when both crops are profitable, producers like to plant corn. That's the reality of it. So I've kept it at 90.5, but we could see a higher corn acreage number. We could also see a lower corn acreage number if soybeans went out. So I just offer that up as a conclusion. And then next year's season average farm price at 365, which you will note currently that's below that 370 benchmark. So just keep that in mind as we think about it. The big story out of yesterday was the surprise in corn stocks. So what I'm showing you here is the shock to the market for December corn stocks all the way back to 1983. If there's a black bar, that signals that the trade or traders were way too high compared to what we actually had. It was a bullish surprise. If the bars are red, that means trade was too low compared to what we actually had, and that's a bearish surprise. And you can see for the last 3 years, we've had bullish surprises, but the last two have been really bullish. Last year, we set a new record, and then we pretty much just swamped it this year. Two things for that. One, we had a lot less on the 2020 crop. And keep in mind, basis prices have been signaling to us for that all year. They've been telling us that the crop has not been there. USDA kept saying it was, but it was even the crop reporters, right? You look at the crop index, the weekly crop conditions, and you go back and those were even too high. Now that we see that 172 yield. The other thing is demand was a lot stronger during this first quarter of the marketing year compared to what we thought. So all those concerns we had around livestock and feeding livestock and everything and pigs getting killed, that seems to not be an issue. We have lots of animals and we're feeding them well. That's the story with the increased demand. So both reduced the supply for 2020 or the crop for 2020, and then stronger than expected demand for this first quarter. But then you look at the supply side or the production side, and it was that drop in yield of almost 4 bushels, 3.8, almost 4 bushels from the November crop estimate to the final. And that's the largest estimate we've ever seen. It shocked a lot of people. USDA weights producer surveys heavily when we get to the final number. I appreciate NAS. I always think they do a really good job. They're the envy of the world. To me, this was kind of one of those moments where it was like, I really felt like we should have been able to capture a lot of this in objective surveys earlier in the year. But nonetheless, the producer surveys that came in signaled that the crop was a lot smaller than what the objective yield surveys had said earlier. So that was part of the reason for that. On the soybean side, I'm not going to spend as much time on this, but we've shrunk supply as well. We saw yield come down yesterday, and we shrunk that supply since September, 208 million bushels. And we've increased our demand 113 million bushels in that same period. So at least on the soybean side, we're getting what we need, a shorter crop or shorter supply and more total use, which is increasing our price substantially. And we've seen almost a $2 increase in our farm cash price for 2020 just in this period. here's my estimates for next year. Again, I think the hardest number to pick is that top one, that acreage number of 90.5. Again, if corn wins out, soybeans will have a lot fewer acres, and this soybean price starts to explode. I'm pretty much budgeting in that we need 90.5 just to even maintain the prices we're at here. If we have less than 90.5, we're looking at very high prices next year, just given our current conditions. So again, it's that stocks to use that everybody talks about and that everything's based on, and the tide just turned so quickly in 2020. We went from, again, 2020 is that red line. We went from having record ending stocks in May and June of over 3.4 billion bushels for the U.S. ending or carryout to cutting that in half or even lower than half to where now it stands at just over 1.5 billion bushels. Soybeans, again, we've seen a drastic reduce in soybeans as well. But corn's been the really impressive story of just how quickly we shrunk those corn ending stocks. When we look at Ohio cash prices across the state, these red bars just represent how many days we spent at those price levels, and you can see the price levels at the bottom. So where the bars are the highest, that's when we spend the most time at those prices. The blue triangles represent today, so you can see that we're well into the tail end, if you want to call it the tail end of the price spectrum in terms of today's cash prices. South American production, as I mentioned, is all eyes and concerns on South America. A couple of things I want to point out. The graphs to the left, the big graph shows the deviation in precipitation for the area in the last month. So brown is where they've had less precipitation in the last month than what they normally have during that period. Green is where they've had more precipitation. And then this map down here shows you where they grow most of their corn in this case. Soybeans. These are soybean, the percentage soybeans grow in that area. So really, for Argentina, their prime soybean growing region is right in the middle of kind of this brown area right here. And so it has been dry. That's why we saw USDA lower corn production, 1.5 million metric tons yesterday. They lowered soybean production, 2 million metric tons. Looking ahead, there is some rain expected in the forecast. So the 1 to 5 day weather outlook shows some rain. So does the 6 to 10 day and even the 11 to 15 day. So there is some potential for some rain helping that, which will put some downward pressure on our soybean prices. On the corn, on Brazil, again, we're, same scenario. Here's the deviation from normal precipitation. Here's where they grow the majority of their soybeans. You can see it's been dry. But as I mentioned earlier, the story in Brazil all season long is they've been able to get the rains when they needed it. They've been getting those $1 million rains. They've also got some rain expected over the next couple of weeks. And so, again, if they don't get those, that'll continue to feed the bull of the prices, especially on soybeans. If they get those rains, we could see a little bit of softness or at least plateauing in the short term. I want to talk about Chinese corn demand for just a second. Chinese corn demand is relatively new for the world market. What I'm showing you here in this first graph, this is domestic demand, what China needs for their crop. The black line shows what they're able to produce themselves, and you can see that really starting 3 years ago, that gap started to emerge where they were producing this much, but they consumed the red line. That gap emerged. Their gap for soybeans is much bigger. They have prioritized corn production over soybean production because they know they can get soybeans from South America or the US, but they have prioritized corn production. That gap has largely come from them not being able to keep up on investments in corn yields or corn yield gains, at least in comparison to the United States. We've increased our yield here in the United States much quicker than the Chinese have. The reason that Chinese corn demand has showed up this year is because over the last 3 years, as that gap started to emerge, they've been buying their corn from Ukraine. So you can see here that for every month, the blue bar was pretty substantial, and that's Ukraine. They've been shipping a lot of corn to China. It wasn't until this summer that Ukraine had their driest season in almost 3 decades, or over 3 decades, that the U.S. started to be able to import corn into China. Again, that's really a case of China needed corn. There was nowhere else in the world to turn, so they turned to the United States. And that's what this graph here shows on the left. The black bars represent the entire world of available corn. You subtract the United States and China out of that mix, and you've got the red bar. So the world minus the United States and China is really tight on corn. The black bar represents, in my opinion, an overflated number of Chinese corn stocks, which is again higher, those 90 days there. But keep in mind, we're getting tight on world corn. So if China needs corn, there's only really one place to go, and that's the United States. As we look ahead. And then I talked about that import quota, right? So this purple line is that tariff rate quota. Anything above 7.2 million metric tons imported into China faces a 65% tax. So all this extra here is subject to a 65% tax. And it is working right now, just given the price of corn inland China. But it's something that I don't expect to stick around once supplies start to return other places. I'm going to skip that for now. Let's talk about 2021 plantings, and then we'll go back to the Farm Bill decision. What I'm showing you here is this is the theoretical decision of to plant corn or to plant soybeans. And this is going all the way back to January of 2020. What I've got here is just the new crop corn or soybeans to new crop corn ratio for Hardin County. I just picked Hardin County, so don't yell at me. I did pick Hardin. Not showing favoritism to Hardin, but it's great. It's a great Ohio county. Anyways, here's the ratio, and you can see that when we started last year, the beginning of the year, the market was favoring corn. We assumed that anything that ratio below this bottom black line favors corn. You can see how quickly that switched to soybeans when we were, corn was dropping, price was dropping, basis was dropping due to ethanol plants shutting down, and we swung pretty substantially to favor soybeans, and then we've just maintained that. So if you look today, this is the price today as of, I guess actually yesterday. The incentive is pretty large for soybean acres on the market. But as I mentioned, farmers love to plant corn, and if both crops are profitable, they're going to plant corn. But the big story here is even last year with our growing conditions, we still had almost 8 million acres of prevent plant corn and soybeans. With today's prices, my expectations, we bring those 8 million acres back into, or at least the biggest part of those 8 million acres back into corn and soybean production. So again, that's where I'm kind of coming up with my acreage estimates, but it's going to be a fight between these two crops, and whichever one loses out between, the amount of acreage that's available for corn and soybeans, whichever one loses out, the price potential for them is going to be strong. And that's what I'd say. So my commodity outlook real quick, and then we'll get back to Farm Bill. Fundamentals have improved greatly for both corn and soybeans. Soybeans were first, corn has followed now. And that has been something that I think is the big story on corn is, just that drop in production that we had here in the United States in 2020 from September to yesterday really shows a very bullish story. Trade relationships have improved between the United States and China, but we're not going to reach those phase one trade agreements that were signed earlier in January. We're just, the pace is good. We're on pace for record exports, and I tend to look at it that way as saying, hey, we had record exports to China this year, but we're still going to miss those phase one trade targets. How does the Biden administration treat those? I don't know, and I think that's something to be watchful for. I don't think our trade position is going to change a whole lot under the Biden administration, just because he seems to view China as an adversary as well. But we'll have to see what the retaliation is for missing the targets. South American weather is driving everything right now. We'll continue to see, rains push down our soybean price, or lack of rain increase it. And then again, like I said, the race is on for soybeans, or the fight is on for acreage between corn and soybeans in the United States. My guess, if I was to take a guess, and a betting man today, that corn is favored for the acreage picture, which means that soybean price remains bullish. We have less soybeans than what we need, and we're going to continue to push that soybean price. So that's just my guess, given farmers love to plant corn. All right, here we go. So what do we expect for Farm Bill enrollment? Well, I gave you my estimates for next year's corn and soybean prices. What do the probabilities say? I throw this little joke in here because I know that everybody always thinks that economists, weathermen, and pollsters they're always wrong. And we largely are, because we're always going to miss. We base our estimates off of probabilities and pick the middle one. But there's always some probability. Could corn go to $10? Yes, there's a probability for that. Is it likely? No. Could corn go to $2? Yes. Is it likely? No. And so there's always a probability for everything. and we just base it on the highest probability chances. So when we look at soybeans, I'm going to start with soybeans. Illinois puts this out. You look at these probability charts, and here's the website if you want to look at it on a daily basis. But I'm going to stick with this bottom graph for here just a second. What this is saying is that there's a half a chance or a 50% chance that the price is going to fall below 11.39 next year. That the season average market price for soybeans is going to be below 11.40. There's also a half a chance it's going to be above 11.40. So the question becomes, okay, we need it to be below 8.40 to trigger a PLC payment. That's our reference price for soybeans. So it needs to be below 8.40 to trigger a payment. So if you plug that into this math, it basically says that there's a 10% chance that soybeans are going to be below 8.40 next year, and a 90% chance that soybeans are going to be above 8.40. So, when we're looking at this and saying, okay, is there a chance that PLC could pay? Yes, there's a chance that PLC will pay. And Illinois shows that in their farm bill decision tool. But it's a small chance. It's a low chance that it pays. When we look at corn, again, the same probabilities and same thing kind of emerges. I'm going to point you down. Oops, I'm sorry. I'm going to point you down here. There's a 38% chance that next year's corn price will fall below 370. Again, this just signals the higher corn acreage that's expected next year. There's a 62% chance that the price will be above 370. So again, we have to be below 370 to trigger a PLC payment. So again, you can look those up on a daily basis if you want. I think it's a really great tool that they've built just to kind of help understand probabilities. But here's how I like to look at farm bill decisions. And I'll throw this out there for you to consider as an option for making this decision. Basically, what information do we have today that can help us make our decision? I already told you early on in this presentation that we have the least amount of information we've had in a long, long time. And so is there ways that we can use the information we do know to make our decision? And so the way I've done this is I've decided, what if we took the market year price for the current year as a ratio of the payout or as of the reference price, right? So corn, I told you earlier, USDA is estimating a $4.20 market year price for this year for corn. That's what today's market year price is. Basically, the ratio that I'm talking to you about here is taking 420, the market year price for today of this year, and dividing it by 370, the reference price for the current crop, right? And I get a ratio, and that ratio is going to be, below or above 100. And that's what I've done here is just historically, here's the number of times these ratios have fallen for all the crops in these different price categories or these different percentiles. It'll make more sense as I go through this. The way to look at this, though, is if that corn ratio, for instance, so $4 or 420 to 370, we know that's a positive above 100. Let's just say it's 100 and 110, 113, right? That's where these categories come in. And red bars are ARC County, gray bars are PLC. And so when that ratio is 80% or less, both programs have a 100% chance of paying out historically. That's what this is telling us, is that when that ratio is 80% or less, ARC County and PLC both pay. However, if the ratio is more than 130, ARC County is really the only program that has a chance of paying out. PLC drops off pretty substantially. So you see this frequency of ARC County. ARC County pays out frequently, no matter what the price signals are, because of the yield component. PLC drops off pretty rapidly. In reverse, what are the size of these payments? And this is where it comes in the trade-off. ARC County pays out more frequently, but when the payments are made, PLC makes the biggest payment. So here you can see that, for 80% or less of that ratio, PLC had an average payout of $81 to ARC County's 23. So even though they both had a 100% chance of paying out, PLC payments were a lot larger. And so the story here is really ARC County is more frequent, but if a payment's made, PLC makes the payment. So if we divide these up into categories, and I'm just going to pick less than 95 for our first category, between -5 and +10 for the second category, and then above 10. Those are my three categories, okay? If we take that and put the ratios right now, as of yesterday, in comparison to their reference prices, here's all 21 commodities that have a PLC and ARC decision. So if you've got oats or barley or something on your farm, you know, they're included in this, right? So anything above 110, I told you we're going to break them into 3 groups. So that first group is represented here in the purple bars. Well, there's 7 commodities in that, and that includes corn and soybeans and grain sorghum. They're all above 10% above. This signals to us, based on that previous slide, that PLC is unlikely at all. If you know, it is likely, there is a possibility, but it's very small that it's going to pay out. And ARC County has the greater chance of triggering. So if you're looking for just any payment, ARC County would make sense up here just because it's the most frequent. These middle categories, you know, cranberry, safflower, and sunflowers, I don't think we have a lot of base acres of those, but this would be where the toss-up is, to where we couldn't decipher. There is not a clear signal. And then the black bars, there's 13 commodities down here, including wheat and barley. This is where that ratio is 95% or less, right? This is where PLC, you know, both programs might trigger. ARC County and PLC might trigger, but PLC has the chance to trigger the larger payment. If you go back, when I was showing you the 2019 payments for Ohio, and we were looking at wheat, and I told you that, you know, wheat paid out almost equally for ARC County and PLC, but PLC was a little bit higher. That basically tells you this story, right? That both programs at that ratio have a chance of paying out, but PLC has the chance of making the higher payment. So that's the way I would look at that when you think of it. And it certainly it played out in 2019 as well. So Ohio State's got Farm Bill tools. Ours is getting adjusted right now. I was working on it yesterday, but then the WASD came out and I had to work on grain market stuff. But we do have a website. Mary mentioned it earlier. We've got nice resources. Chris and Mary are updating that. I shouldn't say we. I was a part of this, and now I've turned it over to them, and they're doing a great job with it. And so there are resources available at that go.osu.edu/Farm Bill 2021 that you can look for. Real quick, Illinois also has a tool available. So this is Illinois or Farm Docs tool. The one thing I want to point out, and it works great. There's, you know, Farm Docs, a wonderful organization. They do a lot of good things. They assign probabilities to their payouts. So if you're looking here at 2021, and this is Ohio Clark County corn, if you're looking at this, you're going to see that they've got a 70% chance of a PLC payment in 2021 for corn. Again, it's all based on that probability window, but they haven't updated it since the new prices came out. So just be wary of this line down here at the bottom. But they do base everything on a probability. So the way to look at this is there's a 70% chance of a PLC payment. And if there is a PLC payment, here's what it would be. So that's what these percentiles mean when you're looking at Illinois' Farm Doc tool. So here's my closing remarks. Hopefully this was useful to you. We're happy to answer any questions you might have, but program election in 2021 will be a lot different than 2020 or 2014 and 2019. We just no longer have the benefit of knowing as much information as what we did prior to this. So we need to come up with a new way of thinking about these decisions. And that's what I've tried to show you. I've given you 3 different ways of looking at this decision. My simple cliff notes is, you know, wheat favors PLC, soybeans favor ARC County, and corn's a toss-up. But corn even favors ARC County now too, just given the rally in prices that we've seen. That's no different than what we had last year, a year ago, when we were making this decision. That's pretty much the same characteristics there. I do think that farms that went into ARC IC in 2019 are probably going to want to take that out this year. I'm not saying there's anything wrong with the ARC IC program. It just, ARC IC worked because so many farms knew they were 100% prevent plant. And so I think, you know, people aren't expecting to be 100% prevent plant this go around. So it's a possibility to pull that out. But I do think there's still opportunities that fit ARC IC. If your farm is in a river bottom ground, you have high year-to-year production variability, you know, ARC IC makes sense in that case because it's basically either a boom or a bust, if you want to think about it in terms of that. Given the probability of payments being relatively low for ARC County and PLC, some of you might be interested in taking PLC to get the either larger insurance coverage under SCO or the cheaper insurance coverage and then buy up SCO if you want to think about it in terms of that. Certainly that is a strategy that I've heard people talk about. I maintain my position that the best risk management strategy there is to have PLC with SCO. However, it costs more. And so if you don't want to pay for the extra cost, then that's when it comes down to just ARC or PLC. But at least with PLC and SEO, you're participating in both programs. You're paying that fee to participate in both programs. Sometimes it makes sense to put different farm numbers into different programs. We did this on our farm this year. My family farm, we have 12 different FSA numbers. 5 of our farms are in ARC County corn, and 7 of our farms are in PLC corn. So you can do that. You can mix match across farm numbers if you want between the different elections. It's a great risk management strategy of diversification if you want to think about it in terms of that. And it does work. So I just throw that out there as a possibility. And so with that, I want to thank you for your time. If you got any more questions, I'm happy to answer those. I see we have some in the box. But do want to thank you for your time. We'll have this recording and then all the decision aids up online for you to access. But at this time, I'll turn it back over to Mary and Chris if there's any
things at that same link where you registered today, which is shown on this slide. So if you want to come back in a month and see if anything's changed, or if you just need a refresher, you can do that. And like I said, the recording for today will also be up on that website. Ben mentioned that he and Aaron Wilson will be doing some more in-depth Outlook meetings this winter. So if you want to come back and really dive into Outlook as you're thinking about price and what's going to happen with price while you're making these decisions, there are 3 different dates that they'll be doing that. And this is where you can go to register for those programs. Our farm office team is providing some office hours this week. Actually, the first one is this evening. So if you have an interest in getting some other policy updates, asking questions to our farm office team, go ahead and join tonight. And then they'll be back on Friday morning with more updates also. And then we also have some agronomy team programs for those of you who would be interested in getting crop advisor credits and learning about soil health and some other things. So